Jim, let me start with you. The markets seem to read a lot into these jobs numbers that came out on Friday. Is the market right to read that much into it?
I think it's a little premature to declare victory on either inflation or that we're going to achieve a soft landing. The numbers were unequivocally good. The ninth month in a row of beating expectations shows that this economy's got more resiliency. The 3-month wage number at up 4.1% is edging down to that more acceptable range, but we've still got a lot of progress to be made. And I think the market's overpricing the Fed moving now, where they've now got 40 basis points of cuts priced in 2023. Our base case is the Fed's going to raise to around 5.25, and stick there for at least 6 to 12 months.
So, Sarah, what about it? I guess the question isn't so much what is actually going to happen in the market as what the Fed is going to do about it. Are we overreading what the Fed might do in reaction to numbers like we had on Friday?
Possibly. It appears, at least our team feels, that every piece of good news seems to be offset by some bad news. The recession indicators that are traditional, for example, a steeply inverted yield curve, are certainly present, not just in the U.S. and other countries as well. And then we have this falling commodity prices indicating slowing of demand. And then the excess savings that had built up during COVID, that has been spent down. So, and we have higher cost of housing in terms of mortgage rates. There are so many depressants on the U.S. economy, not to mention foreign economies. It's really hard to see our way out of this without some type of significant slowing, probably a recession.
I wonder, to your point, Sarah, whether there's contradictory information coming in. We had JOLTS numbers out this week as well that indicated that the job market's really quite tight, despite the fact it doesn't look like wages are going up quite as high. How do you take all the data we're getting and put them together so that an investor knows where to go?
Well, this is quite difficult. So from a bottom-up perspective, the best path is typically to be very diversified, and then don't let any risks aggregate in any one particular area, because it's hard to call. Think about where we were a year ago when it looked as if we were in a wonderful value rally, tailwind of everything going well, particularly for places like Europe that had been struggling to get through COVID. And then we had the Russian invasion of Ukraine. So these setbacks occur, and the key is then to be in companies with tremendous financial strength who can endure this.
Yeah, David, I agree. The importance of diversification can't be overstated. If you look back at 2022, the importance of owning real assets in a portfolio was critical, really helped performance. If you look at 2023, it's hard to make big geographic calls, but we do think that underneath the surface of the markets, things like value should still perform well in 2023. They've got significant valuation support still going through this period. Areas like high yield bonds are probably a good place to be, and cash looks really attractive at a 5% yield over the next year.
Why are high yield bonds a good place to be right now?
Well, we think they give you pretty good protection in a more difficult economic environment. You've got a yield to worst right now at about 8.7%. And what the market is doing is showing real confidence that through the cycle, defaults will be relatively well managed in high yield. We think that maybe we'll get to a 3.5% default rate, but over 50% recovery. So that looks at less than a 2% loss rate. And with the yield to worst at 8.7, that gives you a pretty attractive return. And high yield bonds tend to have only about a third of the downside risk that equities do.
So, Sarah, Jim obviously is cross-asset. You focus more on equities. What about in the equities area? We heard just briefly there at the open Steve Ratner saying he thinks it's going to be a hard year for equities. Do you agree with him?
Possibly for overall markets. After all, in particular, the U.S. market has delivered massive returns, well in excess of what is typical, the risk-free rate plus an equity risk premium. And the U.S. returns over the last 10 years have been double-digit percentage per annum. That's quite something. Let's just say we have more downward pressure on multiples. The key then, and I'll sort of coincide with Jim's remarks, is get income. And a number of great companies listed globally are paying investors today. And that's really, if all power went out and the show was over, I would just leave one message, which is get that income soon, lower the duration of your holding, because that's in an environment where there's a real cost of capital is a great strategy.
So, Sarah, obviously U.S. equities have been valued more richly than, for example, European equities. Do you expect actually that will come in?
Likely, and maybe not, in part due to the continued multiple compression that we're experiencing in the U.S. market that should continue as long as we're on a path to rising real interest rates. After all, everything is different now. The era of free money is over, and we don't have a Fed put any longer. Nor do we have other central banks. They are reducing their balance sheets. They're taking liquidity out of the market. And fiscal spending is very much constrained by inflation. In fact, they're both monetary and fiscal are constrained by inflation. And as a result, now it's just all we have is earnings. The liquidity part of the propellant to markets is likely to be very muted for many years.
And David, I'd add to the geographic commentary that people tend to think about the countries that they're investing in as opposed to the type of stocks that they're buying when they're buying, for example, European equities. If you want a value exposure or you want exposure to a reopening of the global economy, you want exposure to Europe over, say, the U.S. So that's one reason that we've taken off our underweight to developed markets outside the U.S. Better value exposure, plus the dollar's probably had its run.
Let me bring something in that may or may not be relevant. Jim, I'll start with you. What we're watching unfold in the Congress, not being able to pick a Speaker of the House for so many ballots have gone on, is that relevant to an investor at this point at all, Jim?
Well, it is. The situation before this was they were not going to pass much legislation, so that was not a market expectation. But now we've really put on the table the risk of the debt ceiling. If there is an individual member of the House that can call for a speaker vote anytime they want, and if there is a tie to the debt ceiling in this agreement that's being made to potentially make Kevin McCarthy the speaker, that is going to significantly increase the risk around that. The key will be, could the Democrats get the Republicans from Democratic-leaning districts to go along with them to pass the debt ceiling expansion, which is really what the American public wants.
Sarah, we've all seen any number of times that the debt ceiling has been an issue. One time it actually affected the credit of the United States government. It usually has gone away. Does it factor into your investment decisions at this point at all, the risk on the debt ceiling?
Well, certainly, because the risk-free rate is critical when doing valuation work, because after all the stock is the present value of all the cash it can generate into perpetuity, discounted by this discount rate, where the risk-free rate or the government bond yield is essential to that. So yes, as government bond yields rises, that is going to cause us to have to pay, be much more stingy in terms of what we paid for stocks. So it's super important. But the U.S. is in good company, unfortunately. So many major countries globally have a significant amount of debt to GDP, and or they have fiscal deficits that are sizable. So I think if it weren't like that, the U.S. would be penalized more. But unfortunately, we have brethren in this race to have a significant amount of debt.